And we can start. So happy Friday, everyone. I hope you enjoy the summer. Today we have a guest speaker in our personal finance learning session. Zhengzheng Pan, smart person, my friend, agreed to talk and educate us on private equity and venture capital. Zhengzheng is an investor, advisor, and most recently teacher. She's been collaborating with Stanford and serving as a guest lecturer there. And previously, she worked at Ant and Ant Group and Facebook. Zhengzheng, so thank you for joining us today. I'm really looking forward to your talk. How are you today?
Good. Thank you, Alex. It's really a great pleasure. Let me try to share my PowerPoint with y'all. Can you see it? Okay. I've known Simon and Alex for, I think, over 2 years now. I really like what they do, which is why I'm doing this. And primarily, I believe that making informed personal financial decisions is difficult and it's very important. I'm very glad that we have people like Simon and Alex trying to solve this problem. To me personally, it's also been like a great experience just learning by doing everything about investment, especially venture capital. Venture capital is this fascinating field that's constantly evolving and never ceases to amaze. So looking forward to spend the next 50 minutes or so with all of you to talk about some of the fundamentals of venture capital. Most of you are from the Bay Area, and here everyone seems to be talking about venture capital all the time. However, as I dive deeper into it in the recent years, I realized that as much as venture capital is being discussed, it is also still very widely misunderstood. So first of all, what is VC exactly? When people use that term, VC or venture capital, it is very common that they are actually mixing three relevant but different entities involved in this. First is a VC firm. A VC firm is an investment company that is structured as the overarching management entity. So a VC firm is responsible, you can imagine, for overall strategy, operation, and management of funds, VC funds, under the umbrella of a VC firm. So VC fund has its official SEC requirements and definitions. I can explain a little bit more later. And it is the nature of a VC fund is an investment vehicle. So it's a pooled capital from investors, LPs, limited partners primarily, to make investments into startups. And when people say, I met a VC, I want to be a VC, are you a VC? They are talking about a VC person, people who work at VC firms. Normally, the most visible VC people or the venture capitalists are the general partners, GPs. And just like any company, there are different roles, not just the general partners or the managing partners, but also analysts, associates, scouts. If you're interested in entering this industry, there are things you can look into. Of course, arguably, a lot of the more junior roles at VC firms are now replaced by AI, but just wanted to put it out there. One analogy I find useful to kind of understand these three different entities is you can imagine a VC firm as a movie studio, and VC funds are the movies that the studios make. The VC people, especially the GPs, are like the producers or directors. Then the startups are the actors and actresses in the movies. So of course, people tend to talk about the big stars, but there are other people in the movie and other people working at the firm. If you're interested, again, there are lots of resources out there, especially I do encourage you, if you're serious about it, there are a lot of good articles on the SEC website itself. But for now, one important thing for you to keep in mind when you think about venture capital, especially as a potential investment, is by regulatory requirement and definition, a VC fund is a closed-end fund with a fixed or finite lifespan, usually 7 to 10 years. This is important because that is fundamentally why, one, your investment into a VC fund is illiquid because there's redemption limitations. And two, if you are a founder, if you're a startup founder, once you take VC fund, once you take investment from a VC fund, then you got put on this treadmill for exit, because payouts and profits need to happen within this fixed lifetime of a VC fund. Speaking of which, there are 3 stages for a VC fund throughout its lifetime. The first stage is fundraising. So if you're a GP, a fund manager, you need to convince investors to pour capital into your fund. This process takes 1 to 2 years. Once you have the capital in the fund, then you can deploy the capital. You can make investments into startups. This takes anywhere from 3 to 5 years. Then once you have those startups under your investment portfolio, then it's management. For instance, if you are taking up board seats as part of the terms for investment, then of course you're involved in managing and overseeing the operation of the startups in that regard. But management could also refer to just consider your portfolio companies as potential deals. You could either initiate or participate in certain liquidity events, and those are part of the decisions you get to make as a general partner GP. So the management piece could take 5 to 7 years, especially nowadays. It's getting longer and longer to exit. So it seems like a lot of the funds are running out of time. As I mentioned, it's possible for the same VC firm to have more than one VC fund running simultaneously. That means at a given time, you could have multiple funds at different stages. This matters to you as an investor or potential investor because it matters the track record of a fund manager, which arguably is maybe the #1 factor when you choose a fund or a fund manager. Now, imagine that a GP comes to you and they are raising their fund 2. And at that time, they already has a fund 1 running and it's partially deployed. So to convince you to put money in his fund 2, they might tell you, hey, I have this interim IRR of my fund 1 of X, Y, and Z. One thing to know about that, which I will show you more later in an example, is that could be overstated compared to the final IRR. I'm not saying that it's deceiving. It's just that there are a lot of metrics involved in calculating the return of capital. And when you approach that kind of decision, it's important to understand the details of the calculation and not just the numbers, because the percentages often cannot be compared apples to apples. Now, speaking of fundraising, some of you might be surprised to hear that those big shots, those GPs, they typically only commit about 1 to 5% to the funds that they manage. I would say 5% is more typical for emerging fund managers and smaller funds. But if you're managing larger funds, like we have mega funds now, billions of dollars, for those individuals, it's not going to be a very high percentage of the overall AUM. The rest of the money then comes from the limited partners, the LPs. They're limited because they're not really involved into the day-to-day decision-making and operation of the money. If we look at the US market, the US venture capital market, this is a loose breakdown per dollars of different types of LP. 1/3 of the VC investment in the United States actually comes from pension funds. The state of California and the state of New York, both are major investors in venture capital as LPs. Founder funds take about 1/6. Universities, a lot of universities like Stanford and Harvard and Yale, they have endowments. Lump that with foundations, that accounts for another pretty large percentage as LPs in the venture capital market. Family offices and high net worth individuals, those takes up a pretty good chunk as well as LPs. Now flip to those LPs perspective, just like all of you as investors, your primary decision is not just how much money I put in this or that, it's your overall portfolio, the asset allocation. So if we zoom into those like major institutional LPs, this is how they are allocating their money. You will see that private equity, which includes venture capital, PE, and other forms of equity-based private market investment, really just one of the asset classes that is large institutional investors put their money in. On the right side, I also put shadow on insurance companies because the interesting thing is they're not a super major player or investor in venture capital, but they do have very large amount of assets. They just take a much more conservative approach to their investment portfolio, which is why they don't put that much money in venture capital. Now, really quickly, I wanted to switch to the founder's perspective. If you are a founder, this is your money map. So this is based on 2024 US market data. You will see that bootstrapping is always an option, because I know some of you might be considering going the founder route. And keep in mind that raising VC funds is neither sufficient nor necessary for startup success. You should always consider bootstrapping, especially nowadays with AI tools. Anyways, traditional VC is still a very, very large chunk of the source of funding for startups. And CVCs are on the rise primarily for deep tech, hard tech, those areas as a strategic partner, in addition to providing equity and capital. Angels, individuals and groups, those are pretty substantial as well. But if you look at the lower right end, you will see there are other types of capital, not just equity-based, but also debt products and hybrid products. Fascinating field, like I said. We won't have time to dive into that today, but wanted to let you know if you are considering either raising as a founder or investing as an investor, there are different vehicles and different types of capital for you to consider, especially in the United States. This is my favorite slide. I will say this is maybe the most important slide of the day. And this is super fresh chart. I think Peter Walker, a lot of you follow, connect to him on LinkedIn. He just shared this chart this week. So I know it's a lot of numbers and dots and such, but if you just look at the orange, dots on the right-hand side of this graph. That's a median. That's a median for DPI. That's distribution ratio compared to capital. So you can consider that as a metric that captures how much actual money you are getting as an investor, the distribution, not just valuation, paper money, but you are getting the payout from your investment. You will see that for all of the funds younger than 10 years or younger, that orange dot, all the orange dots are on the 1, which means you're not breaking even. You're losing money on average. Median is a way better measurement than mean to consider what is the average or benchmark for the investment. The average is losing money, even if you have your money in liquid for a decade. Because, most of the time when people think about venture capital, it seems like this really fabulous thing that billionaires do, or you will become really rich if you participate. I really want to set expectations when you are trying to make this decision that, one, again, it's really in liquid, and two, the payout is not going to be the 10x, 100x, or like Peter Thiel's Facebook 2000x. That's very, very unlikely, extremely unlikely outlier performance. Okay. Here's another example, a little bit on getting the distribution. On LinkedIn, oftentimes people have the tagline like exited founder as a way to portray or to convince others they're very successful, they're minted because they had an exit. So this is from this year. It's about this company that's called Act On. It's a SaaS company, competitor to HubSpot. They were sold for $53 million, which is, technically an 8-figure exit. However, if you look at the details of this exit, you'll realize that's not a particularly good outcome at all. So it's sold for $53 million, but it raised 53 million, which means there's no upside, which means all of the investors, they have lost money. But some of them might get something and some of them will get nothing because only 20 million of the 53 is cash, the rest is equity. And it is very, very likely that the common shareholders, employees, founders, they probably get nothing. So that's a cautionary tale to founders in particular, because again, founders have common shares, which is ranked lower in the liquidation waterfall. But it doesn't mean that founders always get the short end of the stick. Here is an even more fascinating example. WeWork. Everybody knows that WeWork is a pretty epic fail. However, despite that very public epic failure, the founder walked away with $1.7 billion. Lots of analysis and facts and stories about this. If you want to learn more about that, it's really, I think for the history of venture capital development, there are a lot of lessons to be learned from the whole WeWork era, really, at the time. But some people, other than the founder, also made a profit. So Benchmark, one of the investors to WeWork, by estimate, they made a 33x gain, which is pretty nice. However, SoftBank, by estimate, lost at least $4 billion. Goldman Sachs, they wrote off a loss of $80 million. And again, the common shareholders, not the founder, but employees in particular, they got their, well, it's also investment. If you're getting paid by equity, their investment was pretty much wiped out at a 90% loss. All right, now the math part. So all of that stories, what have we learned? What can we do moving forward? You might have heard of the 2 and 20 as a term that describes how and who and how much is paid. So the 2 and 20 refers to the most basic structure of venture capital, but there's a bit more than just that. First of all, let's kind of summarize what we talked about. So what we have covered so far. You as an investor, limited partner, you put money into the GP, a venture fund management company, just for getting your money to be managed by them. Similar to a lot of financial services, you will pay a 2% management fee. So that's the 2 in the 2 and 20. That's management. That's guaranteed no matter what. Now, your GP is going to put all the capital in different funds. Those are the venture A, B, and C. Each VC fund is also structured as an LLC. And then under each VC fund, you have different portfolios. Years later, voila, good news. There's a liquidity event, exit, IPO, M&A, secondary, you name it, but liquidity, cool. Then out of that, 20% will go to the GPs as carried interest or a shorter form of carry. That's a 20 in the 2 and 20. So one thing to note that depending on how the agreement is structured, a GP could collect the 20% carry on a per deal basis instead of per fund basis. That means the overall fund, you as an investor, you are not putting your money in individual deals. You put your money in a fund, right? And you agree to let the GPs make all the decisions with the fund. So it's possible that the overall fund is a net loss. So you as an investor, it's net negative. However, the GP can still collect 20% carry on individual deals within the fund. Again, it depends on the contract. So maybe that's another thing you want to look into when you make your decision. Speaking of decision, it's about asset allocation. So here is a scenario where you as an investor, you have $1 million, you're ready to go, you have committed $1 million to a private equity fund, to a VC fund. Now, the life stages of the VC fund that we showed earlier, there could be overlaps of different stages. So the fundraising, the deployment, that's ongoing. There's a process called capital call, which means that when your GP identifies a certain investment opportunity, they will issue a capital call. That is when you wire the money, the committed capital, into the fund to be deployed and to be invested. But before you receive the capital call, you don't have to wire all the money that you've committed into the fund. Therefore, in year one, let's say the entire $1 million you've set aside, since it's not being called for yet, you put that in the public market, put that in stocks. Then year two, your GP issues a capital call, $500,000 to invest in company number one. So you sell $500,000 from your stock investment, and during that time, from year one to year two, your stocks are doing really well. You made a profit. So after you've sold $500,000, you still have $700K remaining, and you put that $500,000 to company one in your fund. That means your NAV in your private market investment is $500,000, and your total, your portfolio, is the sum of the two, which is 1.2. Now come year three, another capital call for the rest, the other half of the $1 million you committed to. And at the time, good news, the company one that you invested in and the valuation has gone up. So your investment is worth $750K on paper, but it is still pretty nice. Now you sold $500 stock. From year 2 to 3, you've lost money in the stock market. So now there's only $100K remaining. You move the $500,000 to the private investment. Your NAV is now 1.25. Your total public plus private is 1.35. Year 4, wow, this is amazing. You had an exit. This never happens in real life, by the way. This is just an oversimplified demonstration. Keep that in mind. So you had an exit and you got an actual distribution. That is, minus all the fees and carry and what have you. You have, $900K distribution. Also, company 2, the valuation has gone up and it's now $700K. So even after you receive or withdraw distribution, you still have $700K left on paper. That's your NAV. And you have lost some money in the stock market. You have gained some money in the stock market, and you put the $900K distribution in the stock market as well. So this is your total. Year 4, really a banner year. Awesome. Year 5, different story. You also had an exit, but this time it's only $400K. So you've lost money because your investment in company number 2 initial was $500,000, but now you got distribution of $400K, which is not terrible because, it's true that most of I think some of the reasons that I show, 60% is 0x. You just lost all of your money. So at least you still got some money back for company number 2. Stock is also not doing super well. You have $800K remaining. You put the money in the stock market. So now your NAV is 0 because, it's done. And your total is 1.2. I know this is a lot. So let's look at it on a chart. Here, the blue line is the NAV. The red line is stock. And the green line is the total of the two, i.e. your entire portfolio. A lot of you are familiar with the concept IRR, and this is the actual formula of IRR, where CT is cash flow at time T. So the main idea of IRR is a discount because we believe, money in the future is less valuable than the money at present. So IRR is a discount to cash flow to make the NPV, net present value, 0. Excel can do this for you really easily, so you don't have to memorize the formula. We plug in all the numbers from this hypothetical scenario. You will see that you have a pretty good IRR for your private investment, over 13%. Especially, remember previously we talked about if your GP's track record is not a final IRR for a closed, like a down for fund, but for an ongoing fund. If it's interim IRR, then because it's based on valuations, it could be higher. Case in point, year 4. If you were to calculate that at year 4, because that was such a banner year, valuation for company number 2 was higher than the final value, you will see an even higher number of over 17%. As for the stock market, it's a net loss. Therefore, it makes sense that the IRR is negative 3%. But as a total, if you look at a total portfolio, the two combined, you still have a net positive IRR of 3%. Now, if we look a little bit deeper into this, again, very hypothetical, oversimplified, unrealistic scenario, does it mean that it's unwise to put money in the public market, like solely based on this scenario? Because, like it doesn't do that well. IRR from the private investment is way, way, way higher. The answer is no. If you are comparing private market investment and public market investment, especially in this scenario, one of the critical factors is time. So remember the capital call and how you move money back and forth, back and forth. Your capital is not always in the private fund. And because of the formula of the IRR, the shorter duration of capital in the private fund, the more overstated the IRR will be, right? And because you don't have your money in the private fund the whole time, the IRR for the private fund is actually like relatively higher just because of the duration. So instead, here's a much better formula for you to make this decision, which is essentially a trade-off. I'm not going to read the formula, and you just need to remember it's KS-PME, or if you just Google, like public market equivalent or Perplexity or Claude or whatever your favorite tool is. If you want to do research on the formula, loads of information out there. The basic idea is opportunity cost. So you could have put the money in the public market, but you choose to put it in private investment instead, right? So what is the ratio of those two different types of investment? That's the basic idea of this metric. So it's a multiplier where one means it's the same, like you have no loss and no gain by putting money in the private market as opposed to public. Now, again, in this scenario, very hypothetical scenario, that is way optimistic for private market investment, this multiplier is still just barely over 1. And you still need to consider the loss of liquidity, the very high risk, yada, yada, yada. So I think this is a pretty fascinating example. Now what? I just throw like loads of information at you, formulas, math, all cool. So what do you do now? First of all, I think great news for all of you today is there used to be lots of barriers to entry for the private market, which I think for good reasons, really, because the main idea is the risk level is just too high. So it creates a systematic risk if you don't have that kind of barrier to entry or gatekeeper to make sure that everyone who enters this knows that what they're doing. A lot of that has been relaxed or removed now compared to before. Just some very basic requirements still hold. For instance, you need to be an accredited investor, which is net worth over $1 million or individual income over 200K a year. Not terribly hard to achieve for people in the Bay Area. But for some deals, especially the hot deals and certain types of fund, you need to be a QP, a qualified purchaser, which requires individual investment over $5 million, institution or investment manager asset over $25 million. Oh, and for both of those, your primary residence doesn't count. Because it's really about investment. It's really, I think the idea is to use your investment AUM or experience as a proxy to ensure that you understand the risks, you understand how it works. Minimum capital commitment is one of, I think, the more major barriers before, but now it's also being relaxed, especially if you join, syndicates, SPVs, using some of the popular platforms. Some of the deals you can start as low as $1,000 just to kind of like test out the flow or, I don't know, get started. So That's being a lot easier. And for funds, there are also a lot of micro funds and rolling funds that have much lower minimum capital commitment for you to consider. Now, speaking of platforms, this is a small selection, a small example of platforms that are pretty popular. Carta, a lot of people use that to get data insights. They also provide very, very good educational materials, not just on the data like what I just showed, but they also have focus areas on the policy side because they have a fund manager software product. So they're very well aware of the accounting, reporting, compliance, and policy changes. So lots of great resources on that. PitchBook, they have a really good free newsletter you can sign up to. They also have loads of research reports. Compared to Carta, one advantage PitchBook has is it has a more global lens, whereas Carta is more of a US platform. PitchBook has a lot of good data on Europe and other regions globally. AngelList and Sidecar, those are platforms basically plug and play. If you're qualified to participate, you can find pretty good deal flows on those platforms. Hive is primarily for secondary trading. It's a marketplace for secondary. And Percent, it's not equity. Percent is also a marketplace for private credit. So it's like private loans. You have maturity terms. Some of them have collateral, some of them don't. And annual returns are also pretty good. You can check them out if you want. But regardless of what platforms you use or what kind of data you have, it still comes down to the decision making, right? Like, especially on a deal-to-deal basis, should I invest in this? There's the whole evaluation process, quantitative, qualitative, but also there's the mental part. This is my favorite question for everything in life. When I feel stuck, when I'm confused, when I'm puzzled, I always ask myself, what is the problem I'm trying to solve? Like, what is a real problem I'm trying to solve? And that usually provides a lot of clarity, and then I can do the follow-up analysis. Related to venture capital investment, I think there are 3 problems I could solve on a deal-to-deal basis. Profit is self-explanatory. Ego is one of the interesting aspects of this as well. It does feel cool when you tell people I do venture capital investment, or I have money, OpenAI, or things like that. So that suits its own purpose. And discovery is more of a personal touch for me in this regard. On a somewhat philosophical level, I think that's the essence of life. We discover about the world, we discover about ourselves. That is how we learn how everything works, and that is the true beauty and meaning of life. And venture capital investment has provided a lot of really fascinating discoveries for me, getting to know different people, founders, investors, people who are really smart, very driven, and a lot of them ambitious to solve really big problems. That's inspiring. Also discover of communities and demographics that are marginalized and underserved. That's a reason for some of my investment as well. It's not necessary for profit. I mean, it's not charity. That's a different bucket. But I will lower my bar for profit if it's for a good cause. I can pause here, but I also want to show just 3 quick slides in the appendix. One is the trend of venture financing overall is, there's the crazy 0 interest rate era, and now the cold winter, and we're on recovering right now, which means a lot of things are back to fundamentals. I think it's a good thing, but there's still hypes and very, very high concentration risk in all the AI investments. When we talk about private market investment ecosystem, a lot of people say PE/VC. Historically, it's different, but the lines are getting blurred. So that's what I will share now.
Yeah, Zhengzheng, thank you so much for giving us this overview. I think you had a very good slide somewhere in the middle. can you please show, can we go back to that where you show the cash flow and like how it works? I wanted to highlight some of the things there. I think now maybe one or two slides before that. One more, please, where it shows the timeline for.
Oh, I see. Okay.
Yeah, this one. I think this is really important. So when we invest in private equity or venture capital funds, we also need to plan for the cash flow, right? When there is a commitment, right? As Zhengzheng, you said, the capital is not called immediately. So we have to actually keep it in some safer, often in some safer investments. And in this example, you used the stock market, right? But quite often, if let's say I need the money in the next year, I'll probably have to put them in some less riskier assets, right? Because I don't want them to fall 30% or 50% at the time when I need to give the capital, which makes it a little bit harder, right, to estimate the overall IRR, because money until they're invested in the fund, where we invest them in the public markets or maybe some safer investments. And another thing I wanted to highlight on this chart is that you have, when the capital is returned, it's quite often it generates a tax event. So you're paying, as an investor, you're paying taxes on capital gain taxes here. That's another thing to watch out when you invest in venture capital, because let's say if you buy a total stock market ETF, you can buy it and hold it forever and maybe give it to your kids, right? And enjoy that step up cost basis. But if it's a venture capital fund, as Zhengzheng, you said, right, there's a finite timeline, a lifetime for that, right? It's only 7 or maybe 10 years. So every 7 or 10 years, we are going to pay taxes unless it's a QSBS eligible investment, which is like super early stage fund, which allows you to reduce the taxes there. And quite often what we found also, we work with clients who invest in venture capital. It's not just one fund that people invest in. They invest in the first fund. Then a few years later, when they start getting the distributions, they start investing in the second fund of the same VC firm. And that actually requires to think now about like, how does that going to work, right? And what type of the commitment I should make in a follow-up fund, right? And quite often people don't have these tools to do that. So I'm glad that you showed this thing here, and I think it's good to talk about these things. If there are any questions, feel free to drop them in the chat, or just raise your hand and we will take them live. I think we have another maybe like 20 minutes just to chat, right, Zhengzheng, and have a conversation. But if I ask you, Zhengzheng, like if someone is looking to add private equity or venture capital investments, how do they start? What would be a good first step for them?
Yeah, that's a great question. I think it comes down to two factors. One is capital, i.e., or budget. You brought good points, Alex. That's the very first step. Is you do a very thoughtful, calculated, informed process on this is how much money I can set aside for private investment. It could be as little as $10,000 or way more, but that's the beauty of personal finance. It's unique to your individual circumstances. But that
you had some slide right at the end how these big organizations they allocate, right? Do you have any suggestion for individuals, like what is the percentage of their net worth would be maximum allocated towards private equity?
Yeah. Well, as for the institutional breakdown, I mean, anyone can do, again, a simple Google, Perplexity, Claude, OpenAI search to find that data or triangulate your own. For individual cases, again, I think that the beauty and the challenge in personal finance is it's very unique. I don't have a rule of thumb in terms of percentage, because you brought good points on tax, cash flow, needs. It's all very individual. So I think I can provide evidence or advice on that. But regardless, so you do all the process, you calculate how much capital you can set aside. That does matter for your starting point. Because if you want to put your money directly in a VC fund, especially a more traditional VC fund, the minimum capital requirement is still pretty substantial. So unless you have like $250,000 right away or available, that is not going to be a particularly viable approach. Now, so that's factor number one, is your budget. Factor number two is your channel or your access. What access do you have? Those platforms like AngelList and sidecars, those are pretty open. You will still have to request to join certain syndicates and such, but at least they're relatively open. You can imagine VC firms and VC funds, just like startups, the more prestige ones, the hot ones, they are more selective. They won't just take anybody's money. So access is another factor to consider. Access also means if you have a good network of high quality founders, for instance, and just go source your own deals. Or if you don't have that, which I think is perfectly reasonable, then those like networks, angel networks, angel groups, syndicates, platforms, that could be a good way to start. One of the things I want to point out for beginners is please take some time and to learn maybe the boring details. I like reading about policies and regulatory definitions because I like reading them. Maybe you don't, then have your AI summarize it for you. But please do some homework first. Understand what you're getting yourself into, and then when you join those syndicates in particular, know that it's not necessarily you are committing to invest. Joining syndicates gives you a deal flow, and you still decide on a deal by deal basis whether you want to put money into this, how much money you want to put into this. So I think that's a pretty decent way to start for most of beginners, unless you already have established channels and accessibility.
You brought up a very good point about the access to deal flow. So especially if someone is looking to make these direct investments like angel investments, right? In order to get good diversification, an investor needs to have hundreds of companies, right, in their portfolio.
Yes.
But in order to invest in 100 companies, they need to talk to thousands of companies or even more, right? And it turns out that it's a lot of work in this case.
It's a funnel. It's a pretty steep.
Exactly.
So unless you are confident or you can whatever, if you have a large enough top of the funnel, then I think those platforms are pretty decent ways to start.
Yeah, I completely agree with you, and I think that's why most of the people, if they want to invest in early stage companies and startups, and they want to make money, right, and generate returns, it's better to do that through funds, because they provide that diversification and they can actually do that work, which takes a lot of time in this case.
Paperwork too, by the way. All those plug and play are pretty good.
Yeah, there is a question from Matthias about the Y Combinator. So what sets it apart from traditional VCs in how it operates? I'm wondering if you have any thoughts on that.
Yeah, that's a great question, I think, for both founders and investors. So the appeal of Y Combinator is it's like a university for startups. And both the in and out provides kind of additional vetting process that increases success rate. I think in a nutshell, that's the main selling point of Y Combinator, is they are selective on who can be part of the program. And then when you go through the program, you learned a lot, of course, but more importantly, it's still about resources and accessibility. You can access investors, advisors. You have this brand recognition, which opens more doors. Then those two factors combined, that's why you have those unicorn graduates from Y Combinator. So when you are I invest in a lot of YC companies because that's the track record. I I think the process works pretty well. If you search for news, you will see that they are changing their kind of format a little bit. It used to be they have kind of 2 cohorts a year, and now they are changing it to 4.
Yeah.
Some people don't like that because they feel like you're getting less selective. People argue that if you look at the ratio, if you look at the numbers, it's actually getting harder and not easier to enter Y Combinator. So
yeah. The acceptance rate is less than 1% into Y Combinator.
Yeah.
Someone recently did the math and they tried to answer the question if it's possible to come up with some index fund for YC companies. Let's say you just piggyback right on their due diligence, right? And you just invest in all companies of the batch. And what they found interesting in that process when they did the math is that the returns were not great. So they're good actually for Y Combinator, and Y Combinator has been a highly successful incubator. And the difference is because Y Combinator invests in this company at the very different terms.
Yes.
So by the demo day, these companies, they have a valuation about $20-25 million post money, but Y Combinator invests $125,000 at 7%, which gives us under $2 million.
Yes.
And then there is a second part of the deal when they invest on the same terms as investors on demo days, called most favorable nation provision. This is where they get maybe less than 2% of the company. But the biggest upside comes from them investing at the very, very low valuation at the time, which demo investors don't have access to. So that's why they can actually do that type of index investing, but at the demo stage is a bit late.
Yeah, this is a slide that I didn't talk about because it will take too much time. But like one thing I want to point out is for venture capital fundraising, whether you're a founder or investor, the important thing to keep in mind is regardless of all the formulas and all the math, it is about negotiation power. So, especially with valuation, there's like revenue multipliers, there's like cash flow model, like what have you. But fundamentally, it's negotiation power. Just look at Thinking Machines Lab, right? It has no product, like no nothing, but it's $10 billion valuation. Why is that? Negotiation power. And with Y Combinator as well, I have a personal story. One of my GPs did a really great job with one of the Y Combinator companies that we were able to get a fairly, I think, reasonable or low valuation that we know for a fact doubled within the same week. Like a different fund and different GP negotiate with exactly the same company, and the term is significantly different with much doubling the valuation. So that's another important thing to learn when I say you might want to do your research and learn. I actually have some recommended books. If you just search for, I like this legal textbook by a lawyer. It's very dry, but I love it because it really talks about the nitty-gritty of terms, like what are you agreeing to, or parties involved. If you are like academic like me, it's a fascinating field to learn, and those are going to help you.
Is it a book that describes the process from limited partner perspective or founder's perspective? I think the book that you're talking about, it's about more founders. Is that right?
Yes, founders.
Okay, it's from founders' perspective. That describes how the fundraising process looks like, right? I think
it applies to everyone, right? So if you are an investor, you know what the liquidation preferences, the waterfall, triggering events, your rights, and all those things.
I read that book and I found it actually very useful at the time because exactly while it's written, I think, for founders, it shows the process from different perspectives because you have three stakeholders: limited partners, general partners, and founders in this process. Christian is also asking an interesting question. How do you think the strategic goals of corporate venture arms like Salesforce Ventures or HP Ventures differ from traditional VC firms? Can you talk about the difference between corp VCs and traditional VCs?
Okay, yeah. CVC is great. Like I said, they're on the rise. If you look at a number of deals as well as total dollars investing in CVCs, in particular, I think, well, if I were to summarize one word, that's a strategic alignment. So CVCs, you know, not just Salesforce, but also like Google and NVIDIA, they and OpenAI has their investment arm as well. It makes a lot of sense because it's not just the capital, the financial capital support. A success of a startup requires resources. You know, like I said, who do you know? Who can you talk to? And distribution channels. For a lot of CVCs, when I say strategic alignment, distribution is a big one. Like I know the startup founder that got funding from a very big tech company. It's all confidential, I can't say, but it's like a highly relevant tech company, and they are promising to use their platform for distribution for their app, and you instantly get exposure to hundreds of millions of people just because, you know, you have this CVC investment. So I think that is one thing that's significantly different. Another thing is hard tech, you know, like chips and defense. No, sorry, that's grants. And chips and AI, robotics, that sort of deals are also a popular one for CVCs. Then the corporates, you know, behind the CVCs, they can provide early access to their technology. They can also provide, you know, technical advisory services. So that's what kind of makes them different from traditional VCs. Even though traditional VCs, you know, they provide advisory and what have you as well, but it's more from a general business and just being in the field for a long time, knowing a lot of rich people, that sort of perspective, as opposed to the more specific technical and distribution that CVCs can provide.
Yeah, and Zhengzheng, people are asking the name of the book. My understanding it's called Venture Deals, but I want to make sure that we're talking about the same book.
Mine's a different. Geez, I should bring it with me. If on Amazon you search for like law for startup founders and advisory, startup laws for founders and advisors, something like that. Yeah, Alex, I'll send you the link.
Okay, sounds good.
Yes.
Oh,
and fundraising.
Okay. I read a different book, so I put it, I think, the wrong name. Okay, you found it. And I found it too. I read Venture Deals, and I found it also very useful. But these are different books. Okay, but now that.
Cool.
Awesome. So there was also interesting thing in your slides. There was a fund of funds and family offices. What are these things?
Hopefully these things. Well, fund of funds, as the name suggests, it's a investment vehicle. It kind of has like built-in diversification in it. Geez, well, I'm a little bit overly cautious when I talk about financial things. So you can like Google specific definitions. Family offices, you know, for families as well as individuals with very high net worth, they will set up family offices for their investment, to handle their investment for them. It's particularly, I think it's very popular in Singapore, but in the United States, you have some very like high profile family offices as well. Some of the stats that I share, it's probably specific, like the breakout of asset allocation. The family office column is specific to entities with over $250 million. So just to give you an idea of like what kind of offices that we're talking about. And also loosely speaking, you can have a single family office or multiple family office. So single family office, they only manage like for this one, you know, Alex family, or it can be like multiple families.
And for people who are looking to learn also, what do you suggest that they do more angel investing or invest through venture capital funds? Let's say if someone wants to be a founder one day, right, and they want to build connection, what would you recommend them to get started?
You mean from a founder's perspective?
From maybe future founders' perspective.
Oh.
If someone is looking to learn, how the ecosystem works and get some experience, what would you suggest?
You mean gain experience as an investor to prepare for the future when they will be a founder?
Something like that, yes. Maybe build connections and learn how startups work.
Yeah. I think it still comes down to like accessibility. Like it's a lot of different paths could work. There's no one standard path or one standard answer. So look at your network, the people that the people the reputations you've built for yourself, and you can put yourself out there. Just say, I wanted to more about X, Y, and Z, and see who reaches out to you, and kind of like go from there. And again, like the internet nowadays, it's wonderful with so much information and a lot of useful tools I will do summarize for you. But of course, like verify everything all the AI say, like some of them are rich. But
I had a different experience when investing in startups as an angel investor. In some, you actually start getting some reports, and you can actually learn, because they send monthly reports, and you can follow the company progress and understand what are the struggles, what are the challenges that the company needs to overcome. Other experiences are very opposite. It's just you give money and you don't hear anything from them. So if you are looking to learn, so you can ask, the founders, if you're investing directly, like what type of communication you're going to get moving forward. That can help with that.
That's a good point, because it's not necessarily all angel investment give you a burden. Like, no, I think that's actually, if it's important to you, then that should be a factor when you do your outreach. Like I have like one GP in particular, I really like their style. Great communication. It's not like regular report, because honestly, there's not that much to report most of the time. But anytime I have a question, whatever, they always go back to me with like concise but very on point. So I know
how often they share that their expectations about the returns and capital distributions with you. Is it quarterly? Is it annually?
Every time they raise.
Every time they raise. Okay.
Every time they raise it, but in between I can always message them. But that's a good point, because different investors have different preferences too. And for investors, like some of the investments, I don't care that much. It's my profit investment. Like, tell me when you have money for me. But some of the investment, I care a bit more personally. Then I want to know what's going on. Or it's not just a preference thing. It's also like, can I actually help? It doesn't help anyone if you share your struggles, your problems, your issues, and I have nothing meaningful to contribute. I don't think it's actually a particularly good use of for either parties.
Yeah, we have one more question in one minute left. So Sriram is asking, I'm confused between doing MBA to become a founder or become founder, joining Y Combinator and Startup Accelerating. What would be your advice as the right thing for use case?
Well, I guess there are two magical questions that I think that can answer most of the questions in life. One, I already shared what is the problem I'm trying to solve. So when you say I want to be a founder, why is that? Like, what are you passionate about? What's driving you? And two, like, what's my comparative advantage? Like, what is not necessarily like super unique about me, but it's something that's valuable that other people value, and I'm good at it. Like, what can I really utilize? And those two questions combined can usually give you pretty good pointers on which way to pursue.
I really like your framework, right? Asking like, what is the problem that we are trying to solve? I think it helps avoid so many problems, actually, right?
Problems too. Like, why am I so mad now at my husband? Oh, it's actually not about this thing.
I will quickly share my perspective on like whether go into MBA or become a founder, because I actually had exactly the same dilemma maybe 8 years ago, and I was considering doing MBA too, but then I decided to become a founder. I noticed that most of the people who do MBA, they actually thinking more about going into corporate world after that, so they want boost in their career. But again, everyone has like different opinion. I realized that, the best school for me is actually I learn better when I do things.
Yeah.
And when you become a startup founder, actually you get unique experience of understanding all aspects of the business, and it's a very valuable experience. But
It's
then,
also, Alex, like at the time, I imagine you already had your experience at Google as an engineer, so you have the hands-on know-how of how tech works. You've also built your network, you've built your credibility, your reputation. So for somebody else, it might be like a slightly different scenario. But again, it's
that's a very good point. Yes, that MBA gives you access to that network also. Yeah. I think when it comes to working in
sorry, please.
When it comes to working in big tech, so we see only limited lane, right? Like we don't see the whole business, how it works. But you're right that we have access to the network. Please go ahead. I'm sorry, I interrupted you.
I was going to say, it occurred to me as young folks in particular, that's why I do all this teaching and such, is I have a passion for supporting young folks. I understand it might be not that easy or straightforward just to say, oh, I ask question number one, I ask question number two, I can't figure out, I don't know what I'm good at, I don't know what's my thing, I don't know, then just try. One of the things I share with everyone is the first time I was at job market after I got my PhD was 2008, and that was a financial crisis. I got rejected over 100 times, and I'm fine. Look at me now. So it's fine. Like you go try, you'll get rejected, and no is an answer too, and you might get something better. So
thank you so much. Yeah,
there's no embarrassment, no shame in admitting I don't know, and then I will try something, and maybe that will give me pointers. Then just go ahead and do that. Maybe you apply for MBA in Stanford and you apply for Y Combinator. Maybe you get rejected by both, or maybe you get in by both. Then you try something else. You can also do it that way.
Yeah. Zhengzheng, thank you so much for joining us today and talking about this asset class, venture capital, and educating us. Very informative session. So thank you so much for your time.
Yeah, pleasure.
All right, everyone. So thanks for joining us. We will post the recording after the session. And share it so you can watch that. Our next session will be in August. We will talk about creating financial plans, and the date will be announced later. So thank you so much, and talk to you later. Bye.
Bye.